There's been plenty of volatility, and Keith Lerner over at Truist Advisors says that there's more to come. He's advising investors to be more neutral and less on the offense, writing that, quote, "We expect the choppy market environment to persist over the next several weeks and likely months, and we are not likely to see a quick return to new highs." I'm pleased to say that Keith joins us now. So, Keith, new highs is one thing, but do you think we've seen the bottom?
Oh, that's a tough question right off the bat. I think we've seen a short-term low likely in the market, but I just think the upside's capped. And just for context, we downgraded stocks after being bullish back in late February around 6,000. And our point was that the risk-reward was more mixed. Around 5,500, at least you're reflecting some of the uncertainty. You know, when you're down 10%, you're effectively pricing in about a 1/3 chance of recession. So at least some of that bad news is priced in. But you know, at the same token, even though there's so much discussion about tomorrow, this big day we have ahead on the tariff announcement, as we look at the data itself, what we're seeing is obviously we're seeing the consensus bring down their economic forecast. That has not yet translated into profits. So we think there's some downside risks to profits and also profit margins with tariffs. Maybe one last point, that's offset by when you're down 10% historically, when you look a year later, we've had 56 instances going back to 1950. 49 out of those 56 instances, we've been higher a year later. So if I see like I'm saying somewhat neutral, is like on one hand, yes, 10% corrections is good. On the other hand, you're having some changes in the fundamental story, and we think a more neutral posture makes a lot of sense here.
Do you aren't you concerned that we get more and more negative news, economic hard data going the wrong way? I mean, we got jolts that were all wrong today. We got ISM that was all wrong today. And I mean, inflation numbers, CPI and PCE have been pretty good, but it looks like they're set to get worse and worse. The same could be said for growth.
That's right. And I think part of the market move down is a reflection that there's an anticipation that we will see some sluggishness. Now, the question becomes how much. And now, as we talk to some of our, like, say, retail analysts, they're seeing certainly some sluggishness, some slowdown in bookings for the summer. Think about hotels, lodging. I've even heard somebody talking about, you know, a slowdown in mattress sales, which is a very discretionary type of purchase. So I think we're going to see that. And that's also why I think the upside is capped. You know, if the market was priced, much lower, we're still around the 20 multiple, I might be more interested in saying, hey, you know, all the bad news is priced in. But in our view, you're trading at a 20 multiple, and you have downside risk to earnings. So going back to the point about, you know, where the market is, I think as we get back to 58 to 6,000, there's just a lot of selling pressure, which makes for a choppy market. And relative to where you would have been a year ago, we think a more defensive posture, or at least neutral posture, makes more sense today.